Welcome to another episode of China Update, where I provide you guys with the most up-to-date political, economic and geostrategic analysis on the world's #2 economy. My name is Tony. Let's jump in. Okay, happy Monday everybody. I hope you had a restful weekend and have a productive week ahead. China is on vacation for the next 3 days for Labor Day. The preliminary numbers suggest that there are large numbers of Chinese travelling. Policymakers will be hoping greatly for positive consumption data for this holiday period. China Update, however, is not on holiday, and I will continue to publish videos for you all as usual. Let's start with the economy, and indeed today's episode will primarily be looking at economic updates. At the beginning of the weekend, General Secretary Xi Jinping led a special meeting of the party's Politburo in Beijing to discuss the situation for the national economy. According to state media, the gathering of top national leaders celebrated the positive official economic numbers for Q1, but warned that domestic demand is still insufficient. We have covered the Q1 numbers in great detail in previous videos. The consensus internationally is that the performance for Q1 in China was largely positive and signals recovery from the zero-COVID years. And in fact, the data prompted several investment firms to raise their economic forecasts for the year. However, we have also examined contrarian voices who have argued that China's economy is not performing as well as the headline numbers would suggest. After all, the property sector's rebound has only just started and is far from certain. Investment continues to fall, industrial firms are struggling to turn a profit, and youth unemployment is at a record high. And indeed, the market engaged in a massive Chinese stock sell-off in April. It appears that the Politburo is also concerned, expressing at the Friday meeting, quote, "Internal drivers still aren't strong, and demand is still insufficient. Economic transformation and upgrade faces new resistance, and the promotion of high-quality development still needs to overcome many difficulties and challenges," end quote. The meeting also called for improving employment, especially for university graduates. In Friday's video, we discussed the growing youth unemployment crisis in the country, with the rate rising to 19.6% in March. The Politburo meeting also specifically called for further development of new energy vehicles, the construction of battery charging stations, the transformation of the power grid, the pursuit of AI development, and, of course, greater technology self-sufficiency. Next up for the economy, in an unpleasant surprise for policymakers, China's manufacturing activity contracted in April, yet another sign that China's anticipated 2023 rebound remains patchy and vulnerable. According to official numbers published by the National Bureau of Statistics yesterday, Sunday, the official Manufacturing Purchasing Managers Index fell to 49.2 from 51.9 in March. We remember that a number below 50 indicates a contraction in activity. The non-manufacturing gauge of activity in the services and construction sectors declined month on month, but remained expansionary. At best, the data suggest China's recovery remains lopsided, with the production side of the economy lagging the rebound in consumption. Quote, "This is a mixed PMI report and suggests that China's post-COVID recovery has somewhat lost steam and calls for continued policy support," end quote. And, quote, "The recovery of domestic demand is not broad-based. These mixed signals will likely keep the pressure on the government to continue its supportive fiscal and monetary policies in Q2. End quote. Some analysts have argued, however, that the contraction could be in part due to the fact that there were fewer working days in April, due to the public holidays, though it does seem that what appears to be a patchy recovery in the world's #2 economy is reigniting concern in the markets. For example, West Texas Intermediate Futures declined 0.9% after the PMI data was published. China is the world's largest oil importer. Next up, the property sector and BYD. Hey guys, if you enjoyed today's episode of China Update, don't forget to hit that like button. It's just me making these episodes every day. It's a lot of work, but your guys' support is a huge source of motivation. Subscribing and sharing is a huge help as well, and for those who can go the extra mile and help me keep the channel financially sustainable, Patreon and Buy Me a Coffee links are in the description below. Thank you so much, everybody, for the ongoing support. The property market continues to send mixed signals as to whether it has bottomed out or not. According to new data from the People's Bank of China, in the first 3 months of this year, the outstanding amount of individual mortgages rose to 38.9 trillion yuan, $5.6 trillion, representing the smallest growth on record and indicating that there remains weak demand for mortgages. However, China's central bank explains that it's not just an issue of weak demand, but also that households have greatly increased the rate at which they are paying down their debt. As we have seen in recent months, households, likely shell-shocked by the COVID years, and more pessimistic about future income and investment returns, are increasingly paying off some or all of their mortgage early. Interestingly, outstanding loans for property development expanded 5.9%, faster than the 3.7% growth we saw at the end of December, and much faster than outstanding loans for households, who ultimately need to buy the properties. Considering that there already exists a sizable inventory of housing, this credit growth mismatch could be a serious red flag. Mixed messages could be a common phrase we hear in Q2, however, because, according to preliminary data from China Real Estate Information Corp, China's home sales rose for a third month in April, climbing, from a very low base we should say, 31.6% year-on-year to 566.5 billion yuan, $81.9 billion, faster than the 29.2% increase we saw in March. Next up, and finally for today's economy-focused episode of China Update, over the weekend we learned that Warren Buffett-backed Chinese EV maker BYD profits skyrocketed 411% in the first quarter, driven, no pun intended, by industry-leading sales growth. In the first 3 months of 2023, BYD sold over 550,000 new energy vehicles, almost double versus the same period a year ago. Operating revenue rose 80% to $17.38 billion, while the gross margin was 17.9%, up almost 5.5 percentage points, which will give the company space to lower prices as China's ongoing EV price war escalates. As we have seen in previous videos, BYD has ambitious goals for both its domestic market as well as for global expansion. The Shenzhen-based carmaker aims to sell 3 million cars this year, and over the past 12 months, BYD passenger cars have entered markets in Japan, India, Germany, Sweden, Mexico, and the UK, as well as others. Though, so far, total sales in these markets remain modest. Okay, that is today's episode of China Update. Thank you so much everybody for watching. Have a great day wherever you are, and I hope to see you back here for more China Update tomorrow.